Most traders start out small. If you're looking to get into trading and investing, then you may have $100 that you can put aside as genuine risk money that you're happy to trade with, and it is possible to start with this. Hey guys, James here. I've got two types of simple entry-level strategy that you may want to look at when starting out your trading career, whether that's in crypto, forex, or stocks. The fundamentals are the same. I'll be going through an investment type of strategy where you can add to your holdings over time. And then secondly, a more active day trader type strategy. Many traders will have a longer term portfolio and a shorter term trading account to take advantage of short-term news flow and other short-term opportunities. Timestamps will be in the description for you. And if you need more help with some of the things I talk about in this video, some other helpful videos and resources are listed in there as well. So if you are a beginner and you're just starting out, then something like this is going to appear really scary and really complex. But we're actually going to go through every single thing here, and it's not actually as complex as it seems. But first, before we get into some more day trading type scenarios, I just want to go through dollar cost averaging. So if you are starting with $100 and looking to grow your portfolio over time, a lot of people will go for dollar cost averaging. Dollar cost averaging, as you can see, is a long-term strategy and it's price agnostic. What that means is essentially we're just choosing a time period to invest, maybe once a month, once a week, every few days, and you put in the exact same amount every single time. And so you are price agnostic. You're really not looking at prices at all. You're just growing your portfolio over time. And this is great if you're just starting out with $100 or even like $10 or $15 each time, just growing your portfolio. You can see that dollar cost averaging is an investment and not trading. We're not actually day trading here. There's positives and negatives to this. A lot of people say that if you just invest over the long term, your portfolio will actually perform better than active traders. And there's a lot of variables to this. Most investors will actually use both strategies, but you can see there's the benefit of no FOMO. So you're just putting in money at regular intervals and you're not looking at hyped up prices. You buy some at high prices, you buy some at low prices, and your average price is somewhere in the middle. Dollar cost averaging relies on markets going up over time, which is generally what they do, or at least have done in the past. And so we could suggest that they would do in the future, especially when it comes to cryptocurrency markets. We are still in the very early stages of this. It's a small market overall, and we would expect that cryptocurrency markets in general would actually increase and go up in value over time. Just to say that dollar cost averaging, as you can see here, has no mathematical advantage compared to lump sum investing. I'll show you exactly what that means in a second, but you can actually face significant losses with DCA. And this is because if you just choose a cryptocurrency or a stock to go in and you don't keep up with your fundamental analysis of the stock or the crypto or the asset that you're investing in, you can actually just be putting money into a bad investment. So you do have to actually keep up with your investments and make sure that your fundamental analysis is on point. We don't really care too much about technical analysis, but this is what dollar cost averaging looks like. It's essentially having an amount of money, whatever that may be. If it's 500, 50, 10, it doesn't matter. And you put that in at regular intervals. So once a month on this scenario. We can see in the case of Bitcoin right here that we actually get different prices for our Bitcoin. So in May, we bought $500 worth at 49. We bought some more expensive right here, even more expensive in July, but August we actually got some cheaper Bitcoin, and then in September it was more expensive still. It's a very simple scenario that a lot of people use just to invest and grow their portfolio over time. So what we can see here is that if we did dollar cost average, let's say we made a $2,500 investment over these months, we can see that we actually got 0.05 of a Bitcoin, and our average price for our investment is now 2,513. So we actually invested 2.5, and in September we have 0.05 of a Bitcoin valued at 50,200 per Bitcoin. So our investment is 2,513. We made a bit of profit. We can also come to lump sums. What if you just invested the whole lump? So if you actually had a larger amount and you just invested that in May, you can see we actually would have made more money. This is because it just so happens that when we did put all of that money in May, the price of Bitcoin was actually quite low comparatively to September and to other months. And so we would have actually made more money just putting a lump sum in May. Of course, if you're just starting out with smaller amounts, lump sum investing is just not going to be an option for you. But you can see that lump sum investing, you can actually make more money, or as we can see in this example, if you put it all in July, you would have actually made less than dollar cost averaging, simply because the month that you did buy in happened to be at a much higher price. So you can see mathematically, lump sum versus DCA, it all depends when you invest and what prices you get. But if you're just starting out and you don't have a lump sum, DCA is really the only way to go to grow your portfolio long term. That is dollar cost averaging and going towards the investment side. But let's come over to a day trading example. And before we get into the specifics of that, just another tip I would say is definitely to keep a ledger of your inputs. So obviously if you're starting with 100, you're not going to be growing a $100 account into tens of thousands. You're going to need a 100x return if you invest 100 to get 10,000. So that is possible. It has happened in cryptocurrencies. It's not going to be happening in many stocks for sure, or Forex. But the risk that you take for a 100x is extreme. So you'll have to be looking at a really tiny altcoin, a very small project. The risk increases considerably, and the risk of that going to zero is actually quite high. Most successful traders actually limit their losses and let their winners run and invest in projects that do well and better over time. And if you keep putting $100 into tokens that you might think will go 100x, the chances are actually extremely slim overall. And so for sure, you want to be keeping a ledger of your inputs, how much you're putting into the market, and how much your overall portfolio is over time. And it's all about risk management. And we're going to get into risk management in this example right now. So right here on screen, and I'm using Binance for this one. So this is actually the Bitcoin US dollar chart. So if you're new to trading, you can see up here in the left, I'll just scroll up. We're actually using Binance. We can see it. This is the Bitcoin US dollar chart. So we're looking at the value of Bitcoin against the US dollar. And I have some exponential moving averages on the chart as well, a 20 and a 50 period. You can see this 20 here and 50 here. The way that you get any indicators on the chart is to scroll up, come to your indicators, and I can type in EMA here, and that's what I put on the moving average exponential. I'm not going to go into too much detail explaining these for this video. I do have other videos that do explain technical analysis. I'll actually link that in the description for you if you need some more specifics about what all these indicators actually are. But you can see right now how different day trading is to something like dollar cost averaging, when you're literally just going onto a platform, choosing the day that you want to invest a certain amount of money and putting it in. This is slightly different, but certainly if you have a small amount of money, let's say $100, and you want to day trade, a real pro tip is to not use a larger time scale. So you can see up here, I'm actually on the 30-minute chart right here. The longer the time period of the chart, so if you go to a day chart or a week chart even, the percentage moves of the asset are going to be much higher. Obviously, an asset can move more over a longer time period than it can over a shorter time period. This just comes down to volatility of the asset, and even with Bitcoin being historically quite volatile relative to other assets, it can only move a certain amount in 30 minutes compared to what it could move in a month. So a pro tip if you've got a small trading account is to just come down in your time scale. 30-minute is good for me on this one. And this means that we can be taking less risk, because with $100, you definitely don't want to be risking too much in terms of percentage, because you don't want to blow yourself up and you want to give yourself more opportunities to trade. So we've got the 30-minute chart, and then right down here, I'm going to be using this as a day trading or a swing trading example. So this is called the MACD. Again, we can go up to the indicators right here and you can search for MACD and it's going to give you that. Binance has all of these. I'll link Binance in the description if you want to go ahead and use Binance as your trading exchange. I'll also link TradingView in the description as well. It gives you really great analytics tools. A lot of people use TradingView, so you can have a look at those and see which one fits you the best. MACD though is short for Moving Average Convergence Divergence. Sounds really complex, but essentially what it does is plot a couple of different exponential moving averages. A moving average is simply a smoothed out line of price movements. And the MACD takes a couple of these and it gives us a MACD line and a signal line. And we can use these crossovers to actually initiate some trades. I'm actually going to come to the format option right here and show you exactly what we've got. So you can see the inputs. We have a 12 and a 26. These are actually two moving averages. And then we have a 9, which is a signal line as well. So there's a lot going on here, but essentially what we're looking for is for the MACD line to cross over the signal line, and that gives us an entry trigger. Something else to note about the MACD is that we have the 0 line, and you can see that in the middle right here. This is really important. So anything above is actually in bullish territory or possibly overbought territory. Usually you'll see the price relatively high compared to the price previously. And then anything below it on this line would be considered in bearish territory. You might see the price has fallen off a little bit and is relatively low comparatively. So let's go back here and we can draw some of these on the MACD line. So I'm just going to draw some areas right here. So obviously anything around here, this would be considered oversold, possibly an entry right here. So if we see actually that the MACD line is crossing over the signal line, this could potentially mean that the price is moving back up to something nearer normality around the 0 line. We can also see that actually, yes, the price did fall off right here. So we definitely have this match up. And we also see this around here. So we see a big move to the upside right here, and that is followed with the MACD line crossing over the signal line. Now the MACD line is yellow, as you can see, and the signal line is this aquamarine color. So what we're looking for is that yellow line to actually cross over the aquamarine line, and that gives us what's known as a bullish indicator, might be somewhere that we can go long. I would always look for the MACD and signal lines to be in this lower portion or the bearish portion, and then when the MACD moves up across the signal line, I would want to ride that move into the 0 line or possibly just above. So what we're essentially trying to do is ride a bullish move. So the price has come off. We can see that the price is actually reversing. So we're seeing that momentum change from a sell-off into hopefully what is just a move up back to that 0 line. So that's what you're trying for. When the MACD crosses over, that's telling us momentum has changed and we want to ride that into the 0 line or possibly above. That would be a swing trade or a day trade that we would try and get into. We can also see that exact same thing happened here. So we're in the bearish territory down here. We can see the MACD cross over. That crossover is our entry trigger. So we could put in an entry right there. We try and ride that up, and then we'll put in our stop loss to mitigate any risks and our take profit. And I'll get into putting those orders in a second. As we come over to other parts of the chart, you can see that sometimes you just don't really get these very clear triggers. So we can see down here that yes, we are in negative territory right here. We do get a crossover, but the actual strength of the move isn't as strong as we got around here. That is definitely a much stronger move that we saw. We can see right here, we got a big move. So that's obviously telling us there is a strong move and volatility. Around here, the price isn't moving that much. And you can see actually the price didn't move and give us a volatile move as much as it did here. So difficult to trade. As we move on again, you can actually use this to the opposite side on a down move. So right here, we can see that the price actually did move up a lot. And the price on the MACD is actually above the 0 line. Now, some people actually try to sell their assets here. If it's a crypto or a stock or whatever, you might want to actually go short and sell around here and see the move come back down to the 0 line rather than moving up. So you can actually do that as well. If you're a beginner, I might suggest you might just want to go only long until you get to grips with trading and what long and short actually is. So all that we're doing is looking for an entry signal. And if we're going long, we're looking really for the price to be in the bearish territory. That's because if the MACD is in bullish territory, it's much harder for it to continue going up further. So we're looking for an entry signal right here where the MACD and signal line are in bearish territory. We're going to look for a crossover where the MACD crosses through the signal line, which is telling us that momentum is changing and we might be going to the upside once more. And we're going to try and ride that and actually make some profits. So we can actually just use this as an example right here. So what I'm going to do is come over to this indicator, and this is essentially an order indicator. So it will tell us if we would have been profitable or not. So we can actually see right here that there was a crossover. So we're looking around this level right here. We actually got a fake out, as you can see. So what happened is that the MACD crossed over the signal line, but it actually didn't move that much, and we got a fake out and another move down. So this is something you always have to be very wary of, is that if you actually got in around here, that big sell-off happened and then we did move up to the upside. That is day trading for you though. So that is a risk of day trading versus something like dollar cost averaging. But what you can do is really get your entry point. So let's say you did see this and you thought, yep, this is a good signal. It's moving up. You know, maybe you waited a little bit for the MACD to actually move a little bit away from the signal line, which would always be good. Try and actually confirm your entry right there. So we're going to come in at around this level, as you can see. So I'm going to put that right here. So we can come onto the chart. I'm just going to click this right here. And then we have our entry and our exit. So what you can do is actually just change this around. So a stop loss is where you mitigate your risk to the downside. If the position becomes a losing position for you, you'll actually sell out at a loss. This is something that day traders have to put in there. Otherwise they can risk having really huge losses. So we can put in an amount. Now, usually you'll be looking for areas of support and resistance to actually put your stop loss in place. What I would maybe do with a limit of $100 is just have a nominal amount that I'm happy to lose. And you may be happy to lose, let's say 2%. What I said earlier about using a much shorter time frame chart, is that you don't have to take as much risk. If you're using a day chart, you might have to take as much risk as 5, 6, 7%, especially in Bitcoin, because in one day it can move that much. If you're looking at the 30-minute chart, you don't have to take as much risk. So I'm going to take around a 1.7% risk right here. I think that's good because I've seen the chart right here and that was the low and it did bounce off that for me. And with your take profit, I would say if you're looking at around a 1.5 to 2 times ratio, that would be good. Now it gives us that risk reward ratio, as you can see here. So it's at a level of 2 right now, and I'm happy with that. This is actually specifically for Bitcoin. If I was looking at Forex, it would be a lot different because those markets are not as volatile. And so if you get a 2 times risk reward, it's actually very good. But for Bitcoin, it's actually quite normal. What you can see absolutely is that we did make that trade. So you can see that we had our stop loss down here and the price never got here. You can see that the price actually on our entry, this is our entry right here, it moved up, then it moved down again, but our stop loss was down here. So we're not in any trouble. And then what you can see is that the move up actually happened and we got up around here. And the MACD proved that as well, kept moving up, 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 up. And we actually missed out on a bigger move up here. We actually could have made, look, we could have made this much. We could have made a lot. We could have made over 7%. And if we'd actually carried on, it actually kept going up, as you can see. And usually with a day trade, a risk reward of 1.5 to 2 is actually very favorable. Of course, you will get a lot of times where this move doesn't come about and you actually get stopped out as well. So having your risk management in place is absolutely vital. And if you're just starting out with $100, I would say it's more important to understand risk management and mitigating your risks rather than trying to grow it with a risky trade and risk having 20, 25% of your $100 just go in one trade. The MACD is a popular indicator. There are many, many more though. So definitely check others out with other videos. I'll link them in the description for you. Also with $100, definitely keep a ledger and add to your portfolio over time to make it bigger. If you're making 2% on your trades with a risk reward of 1.5 to 2, then at $100, you're only making a couple of bucks. But if you grow that portfolio to say $10,000, then making 2% in your trade is $200. And that is a completely different scenario if you're doing that on a regular basis. Day trading is only one part of it though. Dollar cost averaging is something that a lot of people will do as well. Having an investment portfolio and a day trading portfolio to trade around the edges and take advantage of short-term moves is what a lot of traders will set up. Check out the videos in the description and the other helpful resources in there as well. Do subscribe for daily helpful crypto content, and I'll see you in the next one.